YieldMax ETFs have been all the hype lately in the dividend investing community, and maybe for good reason. As you can see, they offer distribution rates that are on par with that of a dream of any everyday dividend growth investor. And by utilizing a common call writing strategy, their investors are receiving massive dividends monthly, and these funds are only getting bigger and bigger. Now in this video, we are going to dig deep into these ETFs and explain exactly how they work. And of course, if or if not, I think personally they are worth investing into, and exactly my plan moving forward when it comes to these YieldMax ETFs, etc. Now stay tuned because we're going to go over all this and more. Right up to you, please drop a like on this video and subscribe for more future content like this. Now heading over to the YieldMax website, they have multiple different funds that all have a similar option income strategy, but what's cool about these different funds is that they track different stocks. Like TSLY, for example, is for Tesla, APLY is for Apple, OARK is for the ARK fund, and down here we have some newer ETFs for Amazon, Facebook, Google, and even Netflix. Now for the different ETFs that have already been up and running for a while, these four: the Nvidia, the Apple, the Tesla, and the ARK. The distribution rates so far are out of this world. The ARK distribution rate is 55+%, Tesla over 66%, Apple over 33%, and Nvidia over 46%. Now just for example, if we were to compare that yield to something like JEPI, the JP Morgan Premium Income ETF, one of the generally higher yielding covered call ETFs, JEPI has a trailing 12-month dividend yield of just 10.05%, which is absolutely tiny compared to some of the dividends that these funds have been paying so far. Now looking into TSLY, for example, the fund overview says the YieldMax TSLA Option Income Strategy ETF, or TSLY, is an actively managed fund that seeks to generate income by selling or writing call options on Tesla. TSLY pursues a strategy that aims to harvest compelling yields while retaining capped participation in the price gains of Tesla. Now some more important facts for TSLY specifically. TSLY has a gross expense ratio of 0.99%, which is definitely higher than that of most other ETFs out there, but for an ETF with this type of strategy, it sort of makes sense. The net assets are already up to $425.8 million. And I say already because I've been tracking this ETF for quite some time now, and the net assets have been going up very, very quickly. Now TSLY was started back in November of last year, so there is a little bit of track record which we're going to go through here and show you in a second to see how this fund has actually performed since inception, and of course how the dividends have looked. So I know you're probably asking next, how in the world do these covered call ETFs from YieldMax even work? And how are they able to generate such massive distributions for investors? Well, first of all, let's go over some of the basics of a covered call strategy. For those that might not be aware of it, covered calls involve buying shares of a stock and then writing call option contracts on some of those shares. A covered call could also be referred to as call writing, or writing a call option on a security. And for beginners out there, it's going to be a little bit confusing because there are different terminology and different ways to say the same thing. For example, if you want to sell a covered call, you could also say that I'm looking to sell an option. There's many different ways to say it, but they all pretty much mean the same thing. So other investors can then purchase the call option that the sellers are of course selling to them. Now for the contract buyers, they pay a small fee, or in the case of Tesla, Apple, and some of these names that YieldMax uses, sometimes a larger fee to the call writer, known as the premium for doing so. Now the contract gives the buyer of the option the right, but not the obligation to buy shares at a specific price on or before a specified date. In the case of call options, when the share price of the underlying security rises above the strike price that is agreed upon, an option holder can choose to exercise the option, at which point the stock could be called away from the person who wrote the call option or that sold the call option. Now the whole point of this is then the option holder then receives shares at a cost lower than the current market value, and that's sort of the value of buying call options. Their profits will equal the difference between the option strike price of what they agreed upon and where the stock is currently trading minus the premium paid. The higher the stock price rises before the expiration date, the greater the profit for the person holding the call option could be. Because the call option writer receives the income on the deal in the form of a premium, they want the stock price to either stay flat or fall or slightly rise in order to basically keep their shares, but also, of course, make some massive profit off the premium. So now that we know a little bit about what a covered call is and how it really works, when it comes to the YieldMax covered call ETFs, the ETF strategy is going to usually involve a short-term expiration date, say a month or two, and then the fund is going to buy a boatload of whatever stock of whatever YieldMax ETF you're choosing. For TSLY, for example, they're going to buy a ton of Tesla shares. Then after buying the Tesla shares, they are going to sell covered calls or write call options. And of course, like you learned a second ago, by doing so, they are going to earn a massive amount of premium. And a side note, the premium is going to be so high because all the different stocks that YieldMax tracks have a relatively high beta. So the premiums are going to be very, very high, which means more and more premium or more and more income for the ETFs, and then of course for the YieldMax ETFs shareholders. Now, after they buy the shares of Tesla, Apple, Nvidia, whatever it is, they sell the covered call, then you have to wait and see how the market's going to perform within the time period from then until the expiration date. If the shares move up like crazy, well past the strike price. Well, because writing covered calls gives you a profit cap, if you will. The funds are likely going to perform a little bit worse if that happens. But if in theory these names trade somewhat sideways within the time that they execute the trades up until expiration date, well then the profits will be massive and also the distributions will too. But looking a little bit deeper into some of these YieldMax covered call ETFs and seeing how they perform so far. So APLY, of course, is the Apple option income strategy that YieldMax offers. And since inception, the ETF is pretty much trading right where it started. On the max chart, it's down just 2.11% since April. Now, what's incredible though is the dividends that have been paid just in the last few months have been absolutely massive. The dividend just as of recently was 56 cents per share. The one before that was 63 cents. And the one before that was 29 cents per share. Now looking into one of the other YieldMax option income strategy ETFs, TSLY or the TSLY ETF. This ETF has been around for a while and was trading at $21.76 back last November, and now it's trading at $14.88. So the ETF has decayed in price quite a bit, around 32% almost. But looking at the dividends paid as of this point, TSLY has also paid some pretty nice massive dividends, the last one being 83 cents per share and the one before that $1.07. Now what's really crazy is that if we were to chart out the TSLY on the year-to-date time frame and include the dividends, so even though TSLY has traded down pretty bad as far as ETF price, the dividends have definitely made up for it. TSLY is up 73.18% in the last 219 days if we were to include dividends. So even though on the max time frame, TSLY hasn't done all that great as far as the actual ETF price and is down actually pretty close to the 52-week range low, the massive dividends have definitely made up for it and are generating a lot of profit for investors that have bought into TSLY this far. So in my opinion, are the YieldMax ETFs worth looking into and maybe worth investing into? Now for me personally, I'm thinking about setting up maybe a smaller side portfolio where I'm only buying different names of these YieldMax ETFs, maybe say putting $500 or $1,000 every few months into these names maybe equally, and just sort of running an experiment and seeing how they could perform long term. Now this is because I'm personally a huge fan of the covered call strategy, and it's a great way to generate massive amounts of income through the premiums, especially for stocks with higher beta like a lot of these names on the screen. But as far as what I've been somewhat seeing in the dividend investing communities, some investors are going really big on some of these names. And for me personally, my risk profile, that's not something that I'd be comfortable with doing. But I want to hear what you guys think down below when it comes to these YieldMax ETFs. Are these ETFs something that's going to make up a small or large portion of your portfolio in the future? If you enjoyed this video, make sure to please drop a like down below and subscribe for more future content like this. Thanks for stopping by as always, and I'll see you in the next one.